Cześć, dzień dobry, Artur Wiśniewski, stockbroker.pl. Witam Was serdecznie na Pasywnej Rewolucji i zapraszam na odcinek specjalny. Moim gościem będzie Nick Maggiulli ze Stanów Zjednoczonych, autor książki Just Keep Buying, z którym porozmawiam o tym, w jaki sposób inwestować w sposób konsekwentny i skuteczny. Zapraszam Was serdecznie. Hello, Nick. How are you doing?
Good. How are you doing?
Nick is an author of Just Keep Buying, a great book about saving and investing. To be honest, I was mostly interested in the second part, in investing, and I would like to concentrate on this investing part. But first, could you tell us a few words about yourself? What do you do? Are you a financial blogger? Are you a wealth manager? You work for Ritholtz. So what company is it? What do you do in your life?
Yeah, so I work at Ritholtz Wealth Management. I'm the chief operating officer. So I'm doing a lot of the back end stuff, helping design systems for operations. And so there's like a lot of data work and things like that. That's kind of my background. I have like a data background, worked a lot in programming. And that's the same type of stuff I use for the book, right? I do a lot of data analysis, things like that. So that's kind of, my day job. I do work at a wealth management firm. I'm not an advisor. There's a lot of great advisors out there that we have that interface with our clients and talk with them. I'm just the person that's helping make sure the systems are designed so that they can do their jobs effectively.
Okay. How has your investment journey looked like? Did you make any mistakes in your life, or investment mistakes, or you have always been so smart about saving and investing like you show it in your book?
So I have made mistakes, but I've tried to make sure those mistakes are very small. I made a lot of small mistakes, I would say. For example, buying individual stocks that have declined a lot. I think I got swept up in the mania in 2021, bought some tech stocks, those declined pretty badly, 70%, things like that. But overall, I think the mistakes have been pretty small in the grand scheme of things. But I've generally been pretty good about it. For the most part, I have obviously done some silly things with my money. I've also, I bought Bitcoin at 8,000 and then it went up to 50 and I sold a big portion of it. So like I've gotten lucky in some ways and I've gotten unlucky in other ways. So, you have your hits and misses, but for the most part, I've been a long-term passive indexer.
Okay, so the mistakes, the mistakes topic. When I ask about it, you say mostly it was like active ideas to invest. So you say this direction is rather not good. I said I'm going to concentrate on investing rather than saving. But first, I would like a little bit to ask you about saving. How much we should spend and save. There is this movement, financial independent, retire early. Many people say you should work 24 hours a day. You don't spend anything. You save all of the money, and when you are 40, you have early retirement, and then you can finally you can leave your job. The boss you hate, you can finally leave your job and live a happy life. But actually, I'm not buying this vision. I would rather say don't save, don't make life like this. Be more rational, save a little bit, and invest a little bit, spend a little bit. And I would rather say just try to have a nice job rather than saving all of your money until you get 40 and you finally leave your hated job. What is your vision, your philosophy on this topic?
Yeah, I think the thing is, like, if you have a job you don't like, you can get out of that early and still, like, you don't have to like go and just like, oh, I'm just going to save as much money as I can just so I can get out of a job I hate. You can get out of the job you hate whenever you want, right? So that's the thing to keep in mind. It's like if there's something you don't like to do, I wouldn't do that. But yeah, I think it's more about finding, a life that you can just enjoy day to day as long as you can. And I think that's more important than trying to save every dollar. And I think another thing I've seen, I'm not saying this happens to every person in the FIRE movement, but I have seen cases of this where they save all this money, they get to early retirement, and then they don't know what to do. Like, what are they going to do with their time, right? Or maybe they go and they vacation for a year, and after a year, they start to get depressed because they have no purpose in life, right? And I've had conversations with people privately about this type of stuff, and it's not easy for some people to face. You have to really kind of plan what your retirement is going to be. You have to know that vision, even like, okay, let's say I hit retirement, am I really going to be fulfilled just, being on a beach all day or vacationing or whatever? And so that's the big question, is like figuring out, what you really want out of life and then solving for that. And that doesn't mean that you have to necessarily retire early. I don't think there's anything wrong with working. I mean, as long as you're enjoying what you're doing, I think that's the most important part.
Okay, so you said you don't necessarily need to retire early. You can have your job, and you should try to look for balance in your life. In your book, you are saying, you're advising us what we should invest in. And what was surprising for me, you are not saying you buy just stocks and do it only in a passing way. You say there are different asset classes like real estates, which by the way, Polish investors love them. They love real estates. But so you have stocks, you have real estates. You say you can invest in royalties. So you are not saying there is just one asset class in the world, and you rather say there are many asset classes, and you should choose the one which suits you best. It was quite surprising for me, but you have, I think, quite strong preference as regards yourself.
Yeah, so I think people have gotten rich doing a lot of different things, investing in a lot of different asset classes. They've built wealth, in real estate and stocks. They've done it with, fixed income, with a lot of things. Obviously things like risk assets such as real estate, stocks, farmland, businesses, private businesses, those things tend to, build wealth more than something like a fixed income like bond. But at the same time, like there's a lot of options out there. That's the main goal. And it's like, I'm not trying to be like, this is exactly what you need to do, because that path may not work for someone, and another path may be better. And so it's about figuring out what you want. And it's about realizing that the truth is there is no one right way to get wealthy, right? And there's going to be real estate gurus that say, no, you have to do real estate. And there's going to be stock people saying, no, you have to do stocks. And like, no, there's actually, you can do both, or you can do either, or you can just do one or the other. And so I don't like to pigeonhole like people into like certain asset classes, and like then you start to identify with that. I'm a very open person in terms of what you can own, and things will change over time. Like for a long time, I was not the biggest fan of fixed income. I say you should still own some bonds for like the volatility, for less volatility, for lower risk in your portfolio. But now with the US bonds paying as high as they're paying, they're paying, 4.8 something percent within the 6 month to 1 year yield. They're paying 4.8%. That's a pretty decent return. Now like it makes much more sense to own fixed income, right? So it's always about the environment you're in. I can't just say this is the portfolio that's always going to work, because the world changes. Something that works in one period may not work in another. So you have to kind of be open to kind of moving things around slowly, right? And I'm not saying to make massive changes, go from like 100% stocks to 100% bonds, nothing like that. But it's just like, hey, fixed income didn't make sense before, but maybe now it does. And so maybe my 5% allocation can go to a 15 or 20% allocation, right? So it's like figuring out that type of stuff. And it's like the world's going to change, and it's okay if your allocation changes with it, right? I'm not telling people to performance chase either. So it's just like thinking about like the big picture and like what makes sense going forward.
As I said, Polish investors really love real estate, investing in real estate. I think more than a stock exchange.
Mm-hmm.
And you have quite strong preference towards stocks, not real estates. What would you say is the reason? Why do you prefer stocks to real estates?
I think the big reason I prefer stocks, and remember, this is my experience because I lived through, the housing crash in '08 and saw both my parents lose their houses. And I just had a very bad experience with real estate, not me personally investing in it, but seeing others around me get burned in it. And I know that's a bias. It's a very big bias. It's something that's biased to the United States, is biased to my particular experience. And I know it's biased, but because that I haven't really gotten into real estate in that way. And so Maybe one day that'll change. Maybe, 20 years from now, I'll have, rental properties. Who knows? I can't say what's going to happen. I'm just saying, like, for now, I've just been a little bit biased against real estate because of my personal experiences. And I think everyone takes their personal experiences. Like, there's probably people Poland that maybe they got burned in the stock market, or the stocks haven't been, something that has built wealth over time. And so they're biased against it. And I don't know. I don't know the full history of every country and how their interactions with the stock market. In the US, generally, the stock market's been very good for investors over the long term, but everyone, you have to pick what you like and what you want to do. And so I'm not criticizing those that don't like stocks. I have nothing against them. I'm just saying, think about what else is out there. That's all that's my main message.
So you said you have quite strong preference towards stocks, but you wouldn't say in your book you say that you say straight you shouldn't invest in single stocks. Why are you giving us such an advice?
So there's two basic arguments for this. The first argument, which is very popular and it's been around for a long time, is called the performance argument. And it's basically like, you can't beat the market, right? You can go and try and pick stocks. It's very difficult to beat, just like an index fund like the S&P 500, which has, all 500 stocks, or 505 stocks, I guess, in there. It's very difficult to beat the market doing that, right? Trying to pick stocks to beat the S&P 500. So that's the real reason. If you look, and especially if you look in other markets too, like most active managers don't beat the market. Professionals don't beat the market after fees. Something like 70 to 80% over a 5-year period will not beat their benchmarks after fees, right? So that's the first argument. That's not even the argument I like to make. That's a decent argument. It's good. It's worked very well. But my argument is what I call the existential argument, which is, even if you do outperform, let's say over a year, 2 years, 3 years, how do you know that was skill and not luck? And the fact is you don't. It's really, really difficult to tell, right? It's not like, if we went and played basketball, like within 5 minutes, you would know if I have skill, right? Or someone else has more skill than me relatively. I mean, if we're very close in skill, maybe someone could get lucky. There's something like that. But, if me and LeBron James went and played basketball, it would be very obvious that LeBron James has talent and I don't, right? So that's an example where the feedback loop is small. You shoot the ball and it goes in the basket or not, right? You get information about your skill level very quickly, right? Basketball is a great example of that. Investing, you make a stock pick and then you have to wait years before you see that play out, right? And it could go up or down and it may have nothing to do with your original reasoning. Like, I think about people who bought GameStop in like mid 2020, with one reasoning, and then it became a meme stock and got super popular. And I guarantee that's not the reason they originally bought it, right? But they made a lot of money off of it as a result. So those are the types of examples where you just don't know if you're good. And that's the key thing. Like, you don't know if you're skilled, and the amount of time it takes for you to figure out if you're skilled can be very, very long. You might not know if you're skilled for a decade, right? And then even if you are skilled, you can have periods of underperformance. So have you lost your skill? Maybe your skill was only relevant for one period in time, and in a new regime, it doesn't work. So you start thinking about all these thoughts, and it's like, why waste your time doing this? Like, your time is probably far more valuable. You're probably more likely to be a better something else than be a great stock picker, right? Is it likely that you're like one of the best stock pickers in the world? Probably not. It's probably more likely that you're far better at something else. And so you should focus your time on those things.
So you're saying that we shouldn't invest in single stocks and prefer ETFs, because this is your conclusion, because you prefer passive investing to active investing. The question is, how would you describe this passive investing? What kind of ETFs would you consider to say these are they are designed to passive investment? They are the right tool to passive investing. Very broadly diversified, the globally diversified portfolio is the only tool for passive investing, or maybe you say that some sector ETFs or thematic ETFs or factor ETFs is also passive investing. So where is the border? How would you describe the passive investing?
This is a great question. For sure, like a broadly diversified global stock portfolio is a passive investment. Even like a country-specific stock portfolio, I would say, is generally a passive investment. I know in places in the US, like, you get automatic diversification across sectors, right? But if you go to like specific countries, like a lot of like European countries, there's usually like one or two big companies, which is like most of the index, right? So because of that, it's when you do like a specific country, you're going to end up getting, a lot more of one company versus another. So, and you're going to even be more sector specific if you do country specific, and it's not like US. So you're right. Like, is sector kind of getting into active a little bit? It's a blend, right? And so it's a question of, like, for example, if you did like the what we call the Qs, the technology sector, the NASDAQ, that is a sector bet, right? And that is kind of an active bet, but you're still doing diversification. So I'm kind of in the middle on it. I'm not against sector ETFs. I'm not against it, but just realize that like you're going to have periods where you're going to outperform, you're going to have periods where you're going to underperform the market, right? Like that, just by definition, that's going to happen. Like there's no sector that has consistently outperformed the market over a very, very long time, right? There are some that have on average had better performance, but they will have moments of big underperformance. And tech is one perfect example of that, where it has done very well for like the mid 90s to 2000, it did really well. And then from 2000 to 2005, it completely underperformed the market. And then from like 2010 to let's say, 2021, it did very well. And then 2022, it did much worse than the market, right? So you can see there's these cycles that go back and forth. And so I'm not against sectors at all or doing thematic things, but I don't have that for the majority of my money, right? The majority of my money is just in, broadly diversified, global stock stuff, and I just do that and I don't worry about it. And I spend my time on other things.
Okay, so you prefer ETFs to single stocks. It's a good tool for passive investing, but you can use ETFs also for active investing, like basing on momentum. And there's quite a lot of research which shows that it actually works. I mean, doing in active way. What do you think about it? Is it a good idea? Because I would say active investing, the reason to choose to go in this direction is I want to earn more money or have lower risk. So would you say that active investing in this way, I mean, like based on momentum, is a good idea or not?
I mean, I think so. Factors are very interesting, especially stuff like momentum, where there are periods where, like, yes, you can have outperformance, but I don't know if it's always lower risk. It depends. Like the only thing that's like lower risk I can think of as a factor is like, low volatility stocks. That's like the thing that doesn't they don't move around as much during crashes. That's probably the only factor that is lower risk. I think most of the other ones are generally higher risk over certain periods of time. But once you start getting into active bets, you start to identify with those things. You're more likely to make decisions that are like going to, possibly negatively impact your portfolio, right? So for example, I'll give you a very easy example of this. Most of my money is in, passive, long-term, ETFs, like broadly diversified stuff like the S&P 500, global stocks, etc. Right? When that declines, I don't feel bad. Like I made a bad choice. That's just like the market. It's what the market's doing. It's something that I can't control. It's outside of my control. However, when I buy an individual stock, I end up watching that. Even if it's like 1% of my portfolio, I end up watching that thing all day because that's an active choice. I made an active bet. And so I've talked to a lot of people that feel the same way. They're like, oh my gosh, like I could have 95% of my money in this passive vehicle, but this little 5% sleeve, I'm like watching like a mad person, even though it's not going to affect me, right? In the grand scheme of things, that 5% sleeve is very small. It's not going to really impact my finances that much. But you end up thinking about it a lot and saying, oh, did I make the right choice? Did I not? You start judging yourself. And so I think the same thing can happen with these like active types of ETFs. And so I'm not saying you shouldn't do it, but if you think there's someone that might bail on the strategy, if it has like a 5-year, 10-year period of underperformance, which happens, like value, for example, has underperformed, the broader market for a while now. I mean, in 2022, it did better, but like before that, it did very badly for a long time. And so it's really tough to stick with those kinds of strategies. So I'm not against them, but I'm just like, think about what you're getting yourself into and realize you're going to go through periods of underperformance. And the question is, are you going to stick with it? Because if you give up there, you're not going to get that outperformance that could come later, right? That's why it's so tough to do this. If everyone could just buy momentum and make way more money, then everyone would. And that's what happens. People rush into the strategy and they bid all the alpha away. So we'll have to wait and see what happens. But yeah, that's kind of my take on it.
Okay. One of the ways, if I'm afraid of investing in, I'll do it in a different direction.
Mm-hmm.
When is the best moment to invest? Actually, we have 3 popular options: buy now, dollar cost averaging, or buy the dip. Which of these do you prefer and why?
Yeah, so just historically, like the best thing to do is to buy as soon as you can, because on average the market goes up over time, right? And this is a very obvious, like if I can use a very simple thought experiment. Like imagine you had, $100,000, let's say US, right? Doesn't matter which currency you're in, 100,000 units of your currency, and you had to invest it over the next 100 years. Like would you rather put all $100,000 to work now, invest it all now, or would you rather do 1,000 a year for the next 100 years? Like, which do you think is going to lead to more wealth? Now, obviously, most markets are going up over the long term, especially over a century, etc. You would expect that the person that puts 1,000 a year for 100 years is not going to have as much as the person who invested all now. So that kind of thought experiment, take that 100 years and now put it down to 100 months, then do 100 weeks and 100 days. You can see it's the same logic. It's just moving it down, right? And so on average, the sooner you get invested, the better. So like, that's just generally true. Of course, there's going to be periods. Well, Nick, what about at this period? Of course, there's going to be exceptions to the rule, but 80% of the time when you invest right now, you're going to outperform someone who, quote, dollar cost averages in or slowly puts their money in or tries to wait and buy a dip or something like that. They're not profitable over the long run. In the book, I show this, I think, pretty definitively. Like, that I've looked at the data, looked at rolling periods. I've went all the way back to 1926 in the United States. I've looked at other periods. I look at, buying now versus slowly averaging in across international stocks, across gold, across Bitcoin. Like, every asset I've looked at, investing now has always been the right choice, right? And so I until someone can show me data that says otherwise, it's still the right choice. And unless we get into a new regime where that's not true, it's always going to be better, And just think about the premise of it. You're buying something because you expect it to go up. So why would you wait to, like, it doesn't even make sense. Like, you're the whole premise of you putting money in is because you think it's going to go up. And if you think it's going to go up, then why wait to put the money in? Like, it's, it doesn't necessarily make sense to me. So
This is great about your book, that there's so much statistics in it, which help to convince us which way of thinking, which way of behaving is the right direction, and you are actually convincing us with your statistics that buy now is the best idea. But actually, there's also always the emotional part of us, and some people will say, I'm afraid to buy now because I'm afraid that today the market will start going down and I will feel stressed. So what would you say to people who are afraid of this scenario?
I think the issue isn't buying now necessarily. I think it's the riskiness of the portfolio. So, for example, if you're in a 100% stock or equity portfolio, that's probably too risky. If you're going to buy now and that really worries you, then you probably shouldn't be 100% stock. Maybe you should be 80% stock, or maybe even 60% stock, right? And you're saying, okay, I could put 40% of my money into, fixed income right now and 60% into stocks. That wouldn't bother me as much. Then that's maybe what you need to do. And there's even evidence that, a lower risk portfolio buying now outperforms slowly averaging into a higher risk portfolio. It depends the level of risk and over what time period. There's a lot of factors here, but generally it's better to buy now, even a lower risk portfolio. Like, it's better to buy an 80-20 now than to average into a 100% stock portfolio over the next, 12 months. So I think the issue is risk here and the amount of risk they're taking. And it's not necessarily the buy now versus later decision. And so you need to trade the timing risk with the portfolio, like the asset risk. So if you're thinking, oh, there's too much risk here, it's because there's risk in the portfolio. So you should just take the risk out of the portfolio and not worry about the timing risk as much. That's kind of my take on it.
If I was European or American, adding more bonds would be, I guess, great advice. But if I'm from Poland and in here we don't have dollars, we don't have euro, we have Polish zloty, I mean the currency. There is one problem with bonds, with adding bonds to a portfolio, because even if I have a lot of bonds in my portfolio, if most of my portfolio are bonds, as long as I have Polish zloty and I invest in bonds in other currency, I have currency risk. And it means that even if I have mostly bonds in my portfolio, they are in foreign currency, and if I count it to Polish zloty, it will be very volatile. So actually, this is not lowering risk too much. This is the one problem which I see, and the question is if you have any solution to this. And the second problem I can see is that some people say, okay, we add more bonds to the portfolio, but look, now the interest rates are rising. If we look up to the history, there were some long times when interest rates were growing and growing, like between 1940 and 1980, and bonds were a were bad investment, so they are not going to help my portfolio. So what would you say? What would you answer? Would you have some answers, solutions to these two problems?
Yeah, so the first thing might be like, okay, well, what is there a low risk asset that exists in Poland? And maybe that's just holding the currency. Maybe you don't own bonds and you just hold the currency. You're going to lose to inflation, but that is de-risking in one way, right? Like there is some way to de-risk, and maybe that de-risking doesn't necessarily need to be bonds. You're right that if the foreign exchange is an issue, then I would find something else that's maybe lower risk, and maybe that just means holding the currency. And so you're paying an inflation tax, but that tax you're paying, that losses you're having via inflation, I think that might be the thing you just have to do to take the risk out of your equities. That's one thing. And then what was your second question again? I'm sorry about the.
One was the currency risk, and
Yep.
the second question was about interest rates. That there were long periods
Yes.
when they were rising and bonds were suffering.
Yeah, no, that happens, and that's a part of there is risk to holding bonds over the long term, and that's where those types of things happen with rates going up. But the counter I have is like, well, I mean, how else are you going to de-risk? Then I mean, you can just hold cash, right, and you just pay that toll of inflation, or you hold a bond that hopefully pays out something and makes the inflation toll a little bit smaller, or in theory even has a real return over time, which can happen. So there's no perfect answer here, right? If it was super easy, then you would never have to worry about this. But it's even more difficult for investors not in the U.S. because I think the lowest risk asset on the planet, at least as of right now, I think many people would agree, at least in the U.S., that it's short term U.S. Treasury bonds. And so because the Fed can just print more money, right? They control the reserve currency of the world, and as a result, they can just they can always pay off their debt. Obviously, it would cause hyperinflation, all sorts of other terrible issues, but in theory, they can print off their debt, so I never have to worry about being paid back my money. So that's kind of the reason why I tend to focus on U.S. bonds, because they're the only game in town where they can just literally, they will never default, or they shouldn't default, at least in theory. So
what is the best about your book is the title, because I think it's the best answer to the problem, which is very common here in Poland, especially as regards retirement accounts, because there are a lot of people who open the account and they invest once, only single time, and then just forget about their investments. They just leave it, and they don't invest new fresh savings. This is the problem. They just forget about investing new money. So just keep buying is the best solution for the big problem here in Poland, that people don't invest more money. Even if you have the cheapest ETF, it doesn't change your situation if you invest once instead of investing every month or every year. So people forget about it. People forget about investing consequently. What would you say to people, how to remember, how to keep buying, how to remember about investing new savings?
I think you have to make it a part of like a habit, like you do anything else. And maybe that means you have a separate account where you just automatically every month transfer a little bit of money over. And so every month you do that. And as you see that account fill up, then you go and invest it. Maybe you invest it once a month, once a quarter. It doesn't really matter, whatever works. But I think that's the key, is just to make it a habit. Like I think, Warren Buffett said something like, you should buy stocks like you buy food, like you buy groceries or whatever. Like every so often when you go and do stuff, you buy things, you should be buying stocks, right? You should be buying things that are going to create more income for you in the future, right? That's the key. So now the other thing about investing in Europe versus like the US, I know a lot of Europe has much better social safety net. I don't know the specifics of Poland in particular, but I know that, most of Europe generally, it's like there's better transfers. You don't have to worry as much about not having money in retirement because there's more, programs and things like that. So investing is not as big in the culture, like at least in, Europe as it is in the US, because we have defined contribution. You have to put your money into what we call the 401k. And that is how you save money so that when you're old, you pull that money out plus with Social Security. That should be enough to have a decent retirement, right? So that's the thing that makes it a little bit different in Europe as well. But there's a lot of investors out there that are saying, hey, I still want to have enough money so I can do other things besides whatever the government gives me. So just things to keep in mind. So I would say, yeah, just think about that future self. That's what's really important here. So.
And would you say robo-advisors would be a good solution for this problem. In USA, they are very popular. In Europe, they start appearing in the market, but they are quite expensive. They take like 0.5% or 1% a year. So but they offer us to automate our investing. Would you say that paying 0.5% or 1% a year is worth it to keep us investing consequently?
Depends on the person. I think it really depends on the person. I don't think, 50 basis points, 0.5, 0.5%, whatever you want to call it. I don't think that's that high. I mean, 1% can get a little bit higher, but I mean, it's really about what are you getting? Are you getting the value from it? If it's between paying 1% and actually investing your money, or not paying 1% and not investing your money, I would say pay the 1%, because the gains you're expected to get from the investments over a long term will more than make up for the 1% fee, right? The 1% fee is going to be small in the grand scheme of things. So that's the thing. If you can do it on your own, then you don't need to do a robo advisor. But a lot of people just don't want to think about it. They just want to set it up. Hey, I'm willing to pay the 1% fee and then move on. Because the question is, how much is that 1% fee, right? If you have $100,000, right, you're talking $1,000 a year, right? So don't get me wrong. How much is 1,000 a year? Divide by 12, right? You can kind of figure out roughly exactly how much that is. So I mean, whatever works for you, just I would say think about that, and that's the decision. So it's not, I can't say blanketly yes it's good or bad. Obviously, if the fees go high enough, you're starting to pay 4% for a robo advisor, no one's charging that, but let's say it was, I would say that's too high, right? There's levels which are too high because you're starting to take up too much of the return. Let's say we expect a 5% return, long-term return over equities, right? And so if I'm taking 4%, that's 80% of your expected growth is just being eaten away in fees, and we don't want that, right? Well, 20% of your growth, that's not too bad, right? 1%. So just think about that. I think that's the main key there.
In your book, most of the statistics are basing on the horizon, like 30 years, 40 years, very long periods. And this is very good to illustrate situation of somebody who is investing for their retirement, for example. But we also have some short-term goals. We can invest to save money to buy a car for our kids. So we sometimes invest for the goal, which is like, I don't know, 5 years or 3 years. So would you say this advice to just keep buying is as good if we invest in the short term compared to long term?
I mean, in theory, the issue is over a short period of time. Like markets go down. They're not guaranteed to be up 5 years, 10 years from now, Now, over 20, 30-year periods, most markets will be higher. There are exceptions, right? There's a place like Japan, which still isn't higher, still hasn't eclipsed its, 1989 highs, right? So there are exceptions to that. So in the short run, I can't say like, I'm the market's guaranteed to be higher, but I think just keep buying is still relevant, right? I mean, you need to be buying, especially when the market declines. If you're continually buying, you're in theory getting a cheaper price, right? Because if the market does eventually recover, if we make that one assumption, the market will eventually recover, then you're buying at a bargain. So that's kind of the main thinking there. So I would say yes, like the advice is still relevant over short periods of time, especially if there's a decline. But, that's the main thing, is to keep the behavior there, to keep doing it over time. And you'll be surprised at how much it can grow. And I think that's the thing. Like, people don't realize just how much, like for example, my sister, I got her set up on a 401k. She never done it before, had her save money. And I asked her, I said, okay, after doing this for a few years, like, how much money do you think's in the account? She's like, I don't know, $1,000, $2,000. She had almost $10,000 in there after a couple of years. And because she never looked at it, I have the password. She can't even get into her own account because she just said, hey, you set it up for me. So I did it, and she doesn't even realize how much she's saving, right? She vastly underestimates her savings in her account because she's not looking at it. And that's the same thing. You can check it and you'll see it, but that's the thing. Like, over a very long period of time, you have no idea how quickly this thing can grow. So that's the main takeaway here.
Nick, thank you very much. In the end, I would like to say that we have some good news, because to everybody who wants to read this book, and it's really worth it. It's very interesting. I think it's great. But so far it's been in English. But if you live in Poland, if you speak Polish, you probably would prefer to read it in Polish. We have good news, because this book is going to be published in Polish. So Nick is cooperating with Michał Szafrański, and this book is going to be published soon in Polish. So if you would like to get information when it's going to be published, I advise you to get on this URL. It's książka PPK. Can you pronounce it, Nick?
Wait, what'd you say? Oh gosh, I'm trying my best. By the way, I did not write the Polish book because someone is translating it for me.
I just do it for fun. Książka PPK.
Książka PPK, right? Is that
Great.
Książka PPK? There we go.
Okay, so we can get on książka PPK, and you can sign up for information when it's already published, and you can have your own copy. Nick, thank you very much. It was a great pleasure to have you here. See you next time, and have a good day.
Thank you for your time. Thank you for having me on. Appreciate it.